Hello and welcome to Earnings Echo. We put together the most important information about ASML. Today we're diving into a multi-billion-dollar question. Has the massive AI boom permanently broken the brutal boom and bust cycle of semiconductors? Or is the market currently pricing in a total fantasy?
Right, so looking at the Q1 2026 hard facts, ASML brought in revenue of $8.8 billion, EPS was at 7.15, and the real standout is that gross margin, which hit 53.0%.
Which is hitting the very top of their guided range.
Exactly.
But, the numbers look strong on the surface, but does that upgraded outlook actually justify the massive expectations the market's placing on you as an investor? What exactly are they projecting here?
Well, management narrowed and upgraded their full year 2026 guidance. We are now looking at revenue landing between $36 billion and $40 billion.
With gross margins holding at, 51% to 53%?
Yes, holding firmly there.
Okay, let's look at what's actually driving that gross margin beat. How much of this profitability is being skewed by their service revenues?
A pretty significant portion, honestly. Installed base management, or IBM sales, came in at $2.5 billion, beating expectations.
Right, and just for context, this segment handles the servicing and upgrading of existing machines, which inherently carries much higher profit margins than selling new hardware.
Exactly. We also saw the end-use split shift heavily to 51% memory and 49% logic.
Wait, 51% memory? That is a massive signal.
Yeah, it really is.
Because it essentially tells us AI infrastructure isn't just a buzzword anymore, right? It's physically forcing memory manufacturers to buy up capacity right now just to keep up with the massive data demands of AI servers.
Spot on. And on the technological side, the release of the NXE.3800E package was a major catalyst for them. It's a substantial productivity upgrade for their existing equipment.
Oh, right, the one that boosted physical throughput.
Yes, from 220 up to 230 wafers per hour.
Without losing precision, right? Because making chips faster doesn't help if they are flawed.
Right. They achieved this higher speed while maintaining what they call overlay performance.
Got it.
Which is essentially the microscopic precision required to stack layers of a semiconductor chip perfectly.
Makes sense. So if you listen to the earnings call, management wasn't just optimistic. They were practically pounding the table. Are they suggesting this AI narrative is entirely shielding them from normal industry cycles?
Their stance is undeniably bullish. They stated plainly that AI infrastructure demand is drastically outpacing supply. And more critically, their memory customers are entirely sold out for 2026.
Completely sold out.
Entirely sold out. And they're actively accelerating capacity expansions.
Wait, but what about the broader macro risks? China had been a massive looming question mark regarding export controls. Are they just ignoring that?
Not at all. Management explicitly stated that their $36 billion to $40 billion revenue guidance fully accommodates potential negative outcomes from those ongoing export control discussions.
So they baked the geopolitical risk into the forecast.
Exactly.
Okay, so management is incredibly bullish, and they've stress-tested their numbers against macro threats. But looking at the stock price, it seems like the market is already priced in absolute perfection. Let's break down the reverse DCF so you can understand exactly what kind of growth is assumed here.
Sure. So the current inputs are a $475 billion market cap against a 2025 base free cash flow of $11 billion. We apply an 8.5% discount rate and a 3% terminal growth rate.
Okay, let's translate that math. That means the market is pricing in a 13.6% free cash flow compound annual growth rate over 10 years.
Right.
That requires their free cash flow to scale from $11 billion to $40 billion. Think of a reverse DCF like looking at a racehorse's price tag and calculating exactly how many races it has to win in a row just to break even. Right now, the market is pricing ASML like a horse that will never lose a single race for a decade.
Because it implies the current AI capital expenditure cycle must seamlessly bridge into the 2030s without a single historical semiconductor cyclical downturn.
Which is a monumental assumption. So what is the core takeaway you need to remember today?
The long-term story for ASML completely hinges on relentless, uninterrupted AI adoption and a rapid expansion of EUV capacity. Specifically, they're targeting 60 low-NA EUV systems in 2026.
The stock is ambitiously priced and requires flawless operational execution to justify that premium, which leaves you with one final thought to consider for this deep dive. If the semiconductor sector reverts to its historical cyclicality even slightly, how much of that ambitious premium will the market rapidly unwind?
And finally, the obligatory disclaimer. All content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prepped. Catch you again soon.